First of all, let's take a quick glance at the overall macroeconomic landscape, and in particular, four key themes that continue to dominate the short-duration fixed income market, namely tighter monetary policy, elevated global inflation, recession concerns, and the overall market's outlook insofar as short-term interest rates are concerned. With nearly half of the world economy incurring double-digit inflation, offshore policymakers were subsequently forced to increase interest rates at a record-breaking pace. Despite a significant portion of this inflation emanating from cost-push-related factors, monetary policy authorities remained resolute in their battle to curb second-round effects that could potentially keep inflation elevated for longer. Local policymakers too kept at pace with these global trends. However, our interest rate increases were more measured, given that our inflation target breach was relatively less pronounced versus that of our developed market counterparts. Successive supply-side shocks in the form of the COVID-19 outbreak, the unabating geopolitical tension in Ukraine, as well as energy prices increasing above inflation levels, continue to underpin the scourge of skepticism regarding the global inflation outlook. A survey of professional forecasters conducted by the Federal Reserve Bank of Philadelphia currently expects U.S. inflation to average above the Fed's 2% point target in the prevailing calendar year. Similarly, local inflation expectations, as determined by bond investors, still forecast that domestic inflation will average above the Reserve Bank's 4.5% midpoint target over the foreseeable future. On the other hand, we need to be cognizant of high inflation base effects, falling consumer demand levels, as well as a moderating macroeconomic backdrop being rather unlikely to maintain these elevated inflationary pressures. According to the International Monetary Fund, risks of a global recession are currently on an upward trend, with quarter-on-quarter GDP declines already expected as early as this year. To this end, forward guidance obtained from major central banks as well as the domestic interest rate market currently infer a more measured hiking approach from current interest rate levels. Happy to take questions. The reopening of the world economy has to date shown a great deal of resiliency across labor markets, trade, and broad-based industrial activity. However, one cannot discard the adverse lagged effects of a restrictive monetary policy regime, hyperinflation, as well as unabating geopolitics on investment expenditure, real household income levels, and by extension, sustainable macroeconomic activity. So in a nutshell, we do concur with the views of the World Bank, where from an interest rate perspective, this would likely lead to a bull steepening of the global yield curve, where short-term interest rates are likely to retreat from current levels. We always consider three possible outcomes insofar as monetary policy is concerned: a restrictive, a flat, as well as an easing monetary stance. As alluded to earlier on in the presentation, we are of a view that now we are closer to the peak of the hiking cycle, where consensus expects that we may be approximately 25 to 50 bips away from the summit in the case of South Africa. Assuming that risks of a global recession as well as price deflation continue to gain significant momentum, these would lead to short-term interest rates easing over the short to medium term. However, If inflation, and by extension, inflation expectations, continue to remain elevated, then we would likely be in a scenario whereby interest rates remain higher for longer. This will come as much needed relief to income investors following the deep interest rate cuts sustained at the height of the COVID-19 outbreak. Thank you.
Thank you, Keo. With regards to the fund's objective, capital preservation is the cornerstone of everything we do. In this regard, we note that the fund is rated AA by Global Credit Ratings, endorsing the conservative nature of the fund. The second and third points, benchmark beating returns and competitive risk-adjusted returns, merely highlights that we not only measure ourselves against the benchmark STEFI Composite Index, but we also measure ourselves against our peers. Regulation 28 and CISCA governs the credit limits in the portfolio, and we need to adhere to this in the management of the fund. We also like low volatility, as this is a cash portfolio, and we try to limit the downside risk to investors. Most importantly, this fund offers 24-hour liquidity, so if a client puts through a withdrawal instruction today, they would expect their cash tomorrow. The fund is very conservative in its investment approach. We recognize that our investors at this stage of the investment cycle are more likely to be risk-averse. In other words, should an investment perform poorly due to market conditions, they do not have the life cycle to await a turnaround. The fund has outperformed the benchmark despite a challenging global and local economic environment. The purpose of this slide is to illustrate the consistent performance over and above the benchmark over a 12-month rolling period. The low volatility of returns is due to our bias towards floating rate instruments, thereby immunizing the fund against interest rate risk. This is what our clients like most about the strategy. They like the consistency over the short term, medium term, and long term, and the predictability of the returns. This table shows the gross mark-to-market performance of the Nedgroup Investments Core Income Fund over its respective benchmark. The lime green bar illustrates the difference between the fund performance versus its benchmark. As one can see, the minimum outperformance gap tends to be slightly north of 1%, and we have consistently generated this outperformance or alpha since inception. This chart over here shows the wholesale issue spreads of the big four banks over the past 3 years. The reason we call it wholesale issue spreads is because the banks will only offer these spreads on a deal size of 1 billion rand or more. As you can see, before the COVID pandemic, long-term spreads, the 5-year spreads was about 105 bips, and the 1-year spread was at about 80. And at the height of the COVID liquidity crisis, spreads blew out in the 5-year to 150, and the 1-year spread blew out to 117. As liquidity started building up in the system, spreads started plummeting. And at the moment, we do believe that spreads are at its long-term fair value. This over here shows the issuer breakdown. So this shows where investors' funds are invested in the portfolio. The fund has an annuity, a bias, to annuity-style businesses, and that's why we tend to favor the big 5 SA banks. Over 90% of the fund is invested in short-duration debt instruments issued by Nedbank, Standard Bank, First Rand, and Investec, as well as ABSA. The conservative credit selection continues to support returns. The high-quality credit profile reduces the risk of default, which is key to the protection of capital. We source high-quality assets, and here our size is an advantage. This is one of the largest fixed income unit trusts in South Africa, standing at 45 billion as at the end of December 2022. The remaining portion of the portfolio, which is less than 10%, is invested in high-quality corporate credits as well as local branches of foreign banks. This chart shows the instrument breakdown. It's the type of instruments that the portfolio is currently holding. Because the fund offers 24-hour liquidity, we have a preference for NCDs. The fund holds 55% of its cash in NCDs. These instruments are easily tradable and can be converted into cash on the same day, and most importantly, in large volume. NCDs were the only financial instrument one could liquidate at the height of the COVID liquidity crisis in 2020. Banks are obliged to make a market in the NCDs, which makes these instruments the preferred investment to hold in the fund. The pricing is also transparent. Banks publish a bid and offer spread daily on the NCDs. The remaining instruments are not as liquid, but they do offer higher yields than your vanilla negotiable certificate of deposit. Considering the likelihood of rising interest rates, how can one hedge against that? The safest way is through instruments with a floating rate profile. The fund is therefore fully invested in these types of assets. The duration of the fund currently stands at 0.1 years, which means the fund takes on average 40 days to reprice. This low duration protects investors against rising interest rates. Although the fund can invest in assets with a maturity of 7 years, the weighted term to final maturity of the fund currently stands at 2.6 years. This relatively low weighted term to final maturity protects investors from spread widening. We try to achieve a balance between getting a good return while maintaining a relatively low risk. To conclude, the weighted average spread of the fund is 120 basis points, which is 1.2%. With the 25 basis points interest rate hike penciled in at the January 2023 MPC meeting, we expect the fund's yield to settle at 8.75% on an NACM basis. Leading economists see inflation averaging 5.4% in 2023. This means the fund will generate investors a real yield of 3.35% this year. Thank you very much. As per the previous slide, we do expect the fund yield to settle this year at 8.75%, which is a real yield of 3.35%. So, banks' credit spreads, that is a reflection of a bank's funding needs. That has nothing to do with rising interest rates. So if a bank needs money, if they require funding, then bank treasuries, they will pay up for funding, thereby increasing or raising the spread that you earn on an investment. If they don't need funding, spreads will reduce. And we saw this in the COVID liquidity crisis, when banks needed cash and there was lots of uncertainty in the market. Spreads increased, and when obviously with the whole build-up of cash in the system, That occurred around about, say, May 2020, end of May 2020. Then you can see what happened. That spread started plummeting because banks did not need any cash. There was a massive buildup of cash in the fixed income market and in the system, and therefore there was no need for banks to pay up for funding.